Do you worry about the IRS taking a closer look at your tax return? While most taxpayers never face an audit, there are certain red flags that can increase your chances of hearing from the IRS. In today's video, I'll break down the 10 most common IRS audit triggers and, more importantly, how you can avoid them. Stick around because a few of these might surprise you and could save you from unnecessary headaches down the line. And by the way, if it's your first time watching, my name is Navi Maraj and I'm a CPA and tax strategist who helps entrepreneurs save thousands of dollars in taxes. I do that by creating content right here on social media such as YouTube and through a comprehensive tax strategy course that is available on my website at navimarajcpa.com. But for now, let's dive into these 10 items that can cause you to get an IRS audit. Okay, number one, failing to report all taxable income. The IRS receives copies of all W-2s, 1099s, and other income statements directly from employers, financial institutions, and payment platforms. If the income you report doesn't match the IRS's records, you're likely to get flagged. This includes income from side gigs and freelance work, digital payment reported on Form 1099-K, or even gambling winnings. So if you think you're slick by using Venmo, PayPal, or Cash App to conduct business, those platforms began reporting the information to the IRS a couple of years ago, and the IRS is continuously lowering the reporting thresholds so that they have to report your information to the IRS. And you can avoid issues by reporting all of your income, no matter how small or sporadic it is. And this will include cash payments, digital transactions, and rental income. Use reliable tracking methods here if you work multiple jobs or have diverse income streams to ensure that nothing slips through the cracks. Number two, claiming large charitable deductions. Claiming charitable deductions far beyond what's typical for your income bracket can attract IRS scrutiny. They know the average charitable contribution levels for taxpayers in various income ranges, and large discrepancies always raise questions. Here's how you can avoid issues. Number one, if you are contributing large amounts, maintain meticulous records such as acknowledgement letters from charities and receipts for non-cash donations. For non-cash donations exceeding $5,000, obtain an independent appraisal and complete Form 8283. Ensure your deduction doesn't exceed allowable percentage of your adjusted gross income, which is generally 60% for cash contributions. So as an example, if you earn $100,000 and claim $50,000 in donations without proof, you're likely going to get audited. It sounds obvious, but people do stupid things like this all the time. Number three, you're reporting multiple years of business losses. Operating a business that consistently reports losses may lead the IRS to question whether you're running a legitimate business or just funding a hobby. The IRS applies the what's called hobby loss rule to disallow deductions if the activity doesn't show a profit motive. And here's how to avoid this. You just got to document your efforts to make your business profitable, such as advertising, market research, or consulting with professionals. Distinguish personal enjoyment from business intent. If your quote-unquote business looks more like a hobby, like breeding dogs or selling crafts, it might raise a red flag. Ensure you turn a profit in at least 3 of 5 consecutive years to avoid classification as a hobby under IRS guidelines. Number four, claiming 100% business use of a vehicle. Claiming that your car is exclusively used for business is rare unless you definitely own a second personal vehicle. The IRS knows that most business owners mix personal and professional use. So if you want to avoid issues here, keep a detailed mileage log showing the date, purpose, and distance of each business trip. Avoid rounding mileage numbers as this looks suspicious to the IRS. For instance, claiming exactly 20,000 business miles is unlikely. You got to use tools like MileIQ or QuickBooks to automate tracking and create verifiable records. And here's a tip around this. If you're audited, the IRS will definitely request your mileage log as proof of business use, so keep it up to date and organized. Number five, taking higher than average deductions. The IRS compares deductions claimed by taxpayers with similar income levels. So if your deductions significantly exceed the norm, they're likely to investigate. And how you can avoid getting an IRS letter for this type of behavior is just to stick to legitimate, well-documented deductions, right? For example, if you're claiming significant home office expenses, ensure they align with your actual costs. If you need to, consult with a tax professional who can sort of benchmark your deductions against industry norms to avoid standing out. So as an example, if you're claiming $100,000 in deductions and you only have $150,000 in income, that's going to likely raise questions unless the expenses are clearly justifiable. reliable. Number 6, using rounding or estimating dollar amounts. Using rounded numbers like $1,000 or $500 makes your return look less credible. The IRS expects exact figures, and rounded numbers can trigger scrutiny. So ways to avoid this is always report the exact amounts from your receipts and bank statements or other tax forms, and keep all that relevant documentation organized in case you're asked to substantiate the figures. So don't enter, $500 for office supplies. Enter $493 or whatever your actual expenses were. Number 7, not reporting cryptocurrency transactions. The IRS has been cracking down on cryptocurrency transactions, so if you sold, traded, or earned crypto in 2024, you must report it. And so you can avoid issues here by using crypto tracking software to calculate what your gains are, your losses, whatever your taxable income was, and you're going to report those transactions on Form 8949 and Schedule D. If you earned crypto as payment, include it on your W-2 or 1099 NEC as income. And a reminder, crypto exchanges like Coinbase now report your transactions to the IRS, so don't assume they're invisible. Remember, your transactions are on a blockchain. They are indeed traceable if someone spends enough time doing so. Number 8, claiming the home office deduction. The home office deduction is only for spaces exclusively used for business. If you're claiming a deduction for your dining room table or shared family space, that's a red flag. The home office deduction itself is not a red flag. It's if you're doing it in a way that doesn't abide by the rules. So you can avoid issues by ensuring that the space you're using is used exclusively and regularly for business. So what you'll do is you'll calculate the business use percentage based on the square footage and apply it to your home related expenses like mortgage interest, utilities, and insurance. And you'll keep detailed records and photographs of your home office setup as evidence if needed. Number 9, claiming rental losses. Now, rental losses are generally passive and can only offset passive income. If you're claiming large rental losses against W-2 or other non-passive income, the IRS may take a closer look. And you can avoid issues here by familiarizing yourself with the rules for deducting passive losses. Real estate professionals can use rental losses to offset non-passive income, but the IRS's requirements are strict. You must work 750 hours annually and spend more than half your working hours in real estate activities. You must also keep a detailed activity log to provide your material participation. The same thing applies for those of you who are not trying to qualify as a real estate professional, but are trying to leverage the short-term rental loophole. You must document your stays, who is working on the property, and your time spent, okay? Document all expenses related to your rental property, such as repairs, maintenance, and property management fees. Number 10, claiming refundable tax credits. Refundable tax credits, such as the earned income tax credit, are prime targets for IRS audits due to the high error rate. How do you avoid some issues here? Well, ensure your income and dependents meet IRS eligibility criteria. Keep proof of residency, income, and dependent eligibility readily available. Work with a tax pro to ensure accuracy, especially if your financial situation is complex. If you want to save money in taxes without doing anything shady, as I mentioned earlier, I teach entrepreneurs like you how to save thousands of dollars in taxes. Imagine joining Daniela, who saved over $30,000 in her first year, or Jeff, who's now saving over $25,000 each year, or Valerie, who saved over $10,000 by implementing these strategies just in her first year alone. And there are many other who saved thousands of dollars using these strategies. These results are all possible thanks to my unique 3-step process that I created to unlock your tax savings. The first thing we're going to do is I'm going to help you build a strong foundational understanding by teaching how business taxes work and the accounting fundamentals. So here you'll learn about the various taxes your business faces, different tax classifications, how your business structure affects your taxes, and plus you'll master the accounting equation, journal entries, the profit and loss statement, and the balance sheet. Many students say that they get their money's worth from this section alone of teaching you the foundational knowledge. Then, after you've done that, you're going to learn the powerful tax strategies, and nothing is held back here. You're going to discover how to save thousands with an S corporation, how hiring your minor children can reduce taxes, and how to contribute over $70,000 to your retirement account, in a Roth account that is, even if you are a high income earner. And third, you'll implement what you learned step by step with me. Together, we'll put these strategies into action using QuickBooks, ensuring you're going to save every possible dollar. This isn't just about learning the tax strategies. You can do that for free on YouTube and put the pieces together and kind of figure that out. What you usually need help with is the implementation so that you actually realize the tax savings you've learned about. So most students complete the course in just a few weeks. And here's the best part. I offer a 30-day money-back guarantee, and there's no questions asked. The risk is all on me. So if you're ready to start saving thousands and you want to do it the legitimate way, not by the IRS red flag ways we kind of talked about today, visit navimarajcpa.com or click the link in the description below to learn more and preview the course content. And And remember, if you learned something in this video, subscribe to the channel and click on the notification bell so you'll be alerted when the next one is released. Or if you can't wait and you want to learn more right now, click right here to watch another one of my valuable videos. I'll see you there or inside the course.